The market has seen a huge rebound in the last month, with the S&P 500 actually climbing almost 4% in the last month. Now, if we look at it year to date, we can still see we're still in the red, down by about 3.56%. And if we look at my personal portfolio, we can still see I'm down from my all-time high of about $218,000 with my portfolio value currently about $204,000. Now, what's interesting about this is my projected annual dividend income still continues to climb every single month. And yes, this is due to multiple reasons, like the fact I make monthly contributions and I reinvest my dividends, but also the third key to the snowball effect is buying stocks that are constantly increasing the amount they pay out in dividends. This is exactly why my projected annual dividend income continues to climb higher every single month, and in fact, as of right now, it's sitting at about $6,576, which on a monthly basis comes out to about $544. So in this video, we're going to be looking at 4 different dividend stocks that just recently announced dividend increases. And we'll start with the largest company on our list, and that's going to be Apple, and they announced a small dividend increase of about 4%, but along with this, we do have to make note they announced a $100 billion buyback program. Now, I think we're all familiar with Apple somewhat. This is, again, one of the largest companies in the world. And what we can see is in the last year, yes, they are up by about 7.56%. But if we look at them year to date now, they're down over 20%, now trading at $198.53 per share. If we go ahead and jump over to my dividend breakdown sheet and come over here and plug in Apple, and we can see all this data will automatically load in. And like always, if you'd like to download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, we can see Apple currently has a starting dividend yield of just 0.5%. Now, typically when we see lower yielding stocks, obviously we want to see very high levels of dividend growth. That should be the standard for low yielding stocks. But that hasn't been the case for Apple. If we look at the 10-year dividend CAGR, it's about 7%, and the 5-year, it's about 4.37%. Now, in their defense, if we look at the free cash flow payout ratio, it's only sitting at 14%, so they're using very little capital to actually pay out dividends. So if they chose to do so, they could definitely grow that dividend at a higher rate. But here's part of the concern with Apple right now. If we go ahead and jump over to the stock screener and look at Apple, one of the things we'll notice that really has concerned a lot of people is the earnings per share growth over the last 4 years. If we zoom in and take a closer look, we can see in 2021 it was about $5.67, and it really hasn't grown a whole lot over the last few years. In fact, 2024 earnings per share was even lower than 2022 earnings per share. What's even more interesting about this is if we look at revenue per share, yes, we can see it has been growing from 2022 to 2024, but not at a high rate, and it's really revealing when you actually look at the organic revenue growth. Let me go ahead and zoom out just a little bit more and come up here and plug in Apple. Again, the data will load in, and if we actually zoom in and come over here and look at revenue versus cost of revenue. In 2022, Apple's revenue was over $394 billion, but if we look at it in 2024, it was only $391 billion. So organic revenue has actually declined in the last 2 years. Now, on a per share basis, it's still increased. Why is this? Well, it's because Apple buys back a lot of shares every single year. And this was something that we just saw in the recent report. They announced another $100 billion buyback program. So if we jump back over to the stock screener, we can see they've bought back a lot of shares over the past decade, going from 24.3 billion shares outstanding all the way down to about 15.3 billion shares outstanding. So share buybacks are by far the largest priority for this company. It's part of the reason they don't really increase their dividend as high of a rate as we would expect. So we have to keep in mind, this is what we would call a shareholder yield company. So if we go ahead and jump over to Bogle's valuation, let's look at Apple from a shareholder yield perspective. And keep in mind, shareholder yield is simply combining the dividend yield and the buyback yield. How many outstanding shares are they buying? Because again, that's another way to easily reward shareholders. So if we look at weighted average shares outstanding from 2019 to 2024, we can see again, it's decreasing every single year. There was even one year where it decreased by over 6%, which is very impressive. So the average buyback yield for Apple over the last few years is about 3.63%. If we just stay in that range and go with about 3.5%, we can actually see the shareholder yield for Apple is closer to about 4%. So it's really important we understand what's going on with the buyback program with Apple, because simply looking at just the dividend metrics doesn't tell the true story of how they're trying to reward shareholders as of right now. Coming in at number 2, we actually have a very nice double-digit dividend increase of 10.4% coming from Parker Hannifan. And we can see if we look at them on Seeking Alpha in the last year, they're actually up about 15%. And if we look at them year to date, up about 1.82% after they've seen a pretty nice bounce back over the last month. And in just the last few weeks, the company actually released their latest quarter's earnings report, which management felt was very strong. One of the things that the CEO noted is they're seeing margin expansion, consistent margin expansion. So let's go ahead and see what he's talking about. If we jump over to our stock screener, we'll plug in PH. Again, all the data will load in, but if we jump over to our profitability sheet, here's what's so impressive about this company. They're talking about expanding those margins. Look at the gross profit ratio over the past decade. It's gone quite a bit higher. In fact, in 2014, it looks like it was sitting at about 22.9%. Last year, it was 35.76%. Now, during this time, yes, they were growing revenue, but when you're growing revenue and simultaneously getting an increased gross profit ratio, that leads to earnings growing at a very high rate. And that's exactly what happened. In fact, in the past 5 years, they have a 5-year net income CAGR of nearly 13.5%. EPS in 2014 was $6.98, 2024, $22.13. If we go ahead and jump over to the dividend breakdown, come up here and plug in PH. What we can see is the stock is currently yielding just above 1%. It's a little bit higher on a forward-looking basis, but this is certainly what we would qualify as a dividend growth stock, especially in the last few years. The 5-year dividend CAGR is over 13%. So typically, lately we have been seeing pretty consistent double-digit dividend increases, and here's what I absolutely love to see. Whenever I see a stock growing their dividend at a double-digit rate, I want to see what's going on with the free cash flow payout ratio, because if that free cash flow payout ratio is still climbing higher, then that dividend growth is actually not sustainable. But their free cash flow payout ratio has been staying pretty consistently in that 25% range, and that's because the dividend growth is backed by free cash flow growth. Free cash flow is growing at a healthy rate, so they can grow their dividend at a healthy rate. At the end of the day, it always boils down to what's going on with the company's free cash flow, and their free cash flow growth has been very healthy. Coming in at number 3, we have a stock that does not get much coverage, but it's one I try to keep up with pretty closely, and that's Pool Corporation, stock ticker POOL. And we can see if we come down here, it states that they had a 4% dividend increase. Now, what's interesting about this stock is if we look at what happened from 2015 to late 2021, it went from about 50 something to 60 something dollars per share all the way up to over $550 per share. So this stock saw nearly a 10x in about a 6-year time period, but since then it's sold off pretty heavily, and then after that the share price was pretty choppy. And along with this, the company currently has very high short interest at 8.41%, so obviously there are some institutions actively betting against this stock. Now, it's really interesting to dig into the fundamentals of this company. If we go ahead and jump over to the stock screener and plug in Pool, what you can see is pretty much the exact reason we've seen the sell-off. Earnings from 2014 to 2021 through 2022 climbed by a very high amount. It went from $2.50 all the way up to $18.89, but it's declined in the last few years. Revenue per share saw a little bit of a decrease, and free cash flow per share, while it climbed really high in 2023 again, took a step back in 2024. So what's going on? Well, let's take a close look at the margins for this company. Well, what we can see is the gross profit ratio has actually been relatively stable for Pool Corporation. The 10-year average is about 29.37%, and last year's was higher than that, but it was slightly lower than the 5-year average. But what's interesting is if we jump over to Seeking Alpha and look at earnings estimates for this company, we can see they're projected to be relatively stagnant over the next year with a decline expected of about 2%. But after that, they are projected to get back to decent earnings growth. If we look at this company from a dividend perspective, what you can see is pretty much the exact reason I've been watching this stock closely. It's had explosive dividend growth over the past decade with a 10-year dividend CAGR of nearly 17%. The starting dividend yield is low, yes, 1.6%, but the yield on cost is going to be quite a bit higher, obviously, because they've grown that dividend at such a high rate. For example, if we go ahead and just look at the yield on cost for this company, look at the dividend yield section here on Seeking Alpha and zoom out, what we can see is even with a low starting dividend yield, their 10-year yield on cost is above 7%. That's the power of dividend growth stocks. So they're yielding over 7% if you bought this stock 10 years ago. And it looks like with such a low free cash flow payout ratio that the stock should be able to continue to grow that dividend at a high rate, assuming they're able to get back on that earnings growth trajectory. Again, earnings are projected to be a little flat over the next year, but after that, analysts are projecting they'll get back to about 8 to 10% earnings growth. And then coming in at number 4, we have Paycheck, who announced a dividend increase of about 10%. So that's a pretty decent double-digit dividend increase. And this company's done really well in the last year, up about 25%, and in the last 5 years, way outperforming the market, up about 128.7%. Now, this company has a pretty decent combination of starting yield as well as dividend growth. What we can see is the starting dividend yield after the dividend hike is around 2.85%, with a pretty good history of growing that dividend over time. The 10 and 5-year dividend CAGRs are both above 9%, getting close to 10%. Now, what they do is use a lot of that free cash flow to pay out dividends, but that's nothing new for the company. We can see a free cash flow payout ratio of 75 to 76%, which is typically a little bit higher than I want to see it if it's a dividend growth stock, but it's clear it's not actually trending upwards. This is the range that management has kept it in for it looks like the past decade. So despite this, they've been able to reinvest back into the business and have strategic acquisitions to allow them to continue to grow free cash flow at a healthy rate while maintaining a large payout of that free cash flow in the form of dividends. Now, one of the things we need to make note about this company is they did recently go through the acquisition of Paycheck, and this is expected to strengthen the company's competitive position in the human capital management market. And they made note in their recent earnings report that this will continue to operate as a standalone business unit. What do you notice? Revenue per share, earnings per share, and free cash flow per share grow very steadily and very predictably. Why is this? Well, you have to understand the business model behind Paycheck. What does this company do? Well, the company is known for its cloud-based HR administration software products that manage employee benefits, time and attendance, and recruiting solutions. The great things about these large software stocks is they typically have what we would call recurring revenue. So it makes the revenue and the cash flows of these businesses very predictable. There's typically not going to be huge fluctuations in these cash flows. And that's something that investors absolutely love and are typically willing to pay a premium for. On top of this, we can see return on invested capital for this business is actually very high, but we do have to keep in mind it's much easier to achieve a high return on invested capital if you're using most of your capital to pay out dividends. It means there's not a lot of capital left over to reinvest back into the business. But with that being said, we do still like to see the high return on invested capital. If we look at the profitability and income statement sheet, just like we would expect for a software company, they have very high margins with a 10-year average gross profit ratio of above 70%, and last year nearly 72%. So there's definitely some pros to this business model, and the company's obviously performed very well in the last year. Not really any surprise there with the growth we're seeing. So there you go, those are 4 dividend stocks that just recently announced dividend increases. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.